Elon Musk on Twitter today announced that he was going to ask shareholders to approve another stock split. This comes just after there was a stock split back in August of 2020, in which shares of the stock after the 5-to-1 announcement went from 1,300 all the way up to 2,000. Now we have another stock split. We don't know how big it's going to be. It could be a 5-to-1, it could be a 10-to-1, it could be a 20-to-1. But the board is going to ask if they increase the number of shares. Right now they can issue up to 2 billion. There's 1 billion outstanding right now, so they could technically do a 2-to-1 if they wanted to. However, they're wanting to do a lot more, so they're asking the shareholders to approve more shares so that they can make a bigger stock split. Now, obviously, shares of the stock have gone straight through the roof today. It went up 8%. This is a stock that's already worth $1.1 trillion. So can we really expect another move like what we saw back in August of 2020, where the stock went up over 50%? We've seen so far this year, Amazon and Google also announced their own 20-to-1 stock splits. Google went up right away. It was a huge pop right back up to all-time highs, but it ended up giving it all back within 4 days. And likewise with Amazon, it gave its gains all back within 3 days. So we're starting to see a little bit more of a lackluster response to these stock splits. Yes, they're positive for some short-term bounces, but does it change anything fundamentally about the stock? No. It's essentially like having a quarter and somebody giving you 5 nickels in return. You still have 25 cents. And those say, oh, it's more affordable for shareholders to be able to buy it. It doesn't matter. You don't make money off of shares. You make money off of the capital that you contribute. And you can even get fractional shares through like Fidelity now. So it doesn't really make a big difference whether or not you have a half a share or 1 share or 20 shares. Because in the end, the gains come off of the amount of capital you contribute, not how many shares you have. So if you have 1 share at $1,000 or 20 shares at $1,000, a 10% increase is going to be the same kind of return. And remember too, the people who are going to find the stock more accessible in terms of them being able to buy the stock are the last ones that are going to be able to move the stock. Even if they buy it in droves, as $1 trillion stock, it's not going to impact the stock long term in terms of being able to attract a lot of new buyers, because the people who really want to be in it are already in it. And they're not waiting for the stock to get cheaper from a share price standpoint as a result of a stock split. The ones that are not going to have a big impact on the stock. It's exciting, it's sexy, but in the end, it doesn't do anything for the stock itself. It's not creating new products. It's not creating new opportunities. It's just simply changing the way the stock price looks and the number of shares that you hold. But with that said, let's go ahead and look at the stock price. As you can see, over the last 10 days, this stock has gone through the roof. I mean, 44% in 10 days. That is incredible. In fact, one of the biggest runs that I've ever seen from a market cap standpoint in just 10 days. Now, there's going to be people out there that all of a sudden feel like they need to buy this stock because it's making a run following this stock split announcement. I think these are the people who are going to be some massive bag holders in the future. And make sure that you like this video and subscribe to this channel so you can get all of my analysis and research on the stock market, as well as click the join button below so you can become part of the YouTube membership. So it's up 9 out of the last 10 days. You have a massive gap here now that is waiting to get filled. And most of the time, your gaps will be filled. There's heavy resistance overhead too that you want to make sure that you're aware of. If you're going to get long on this stock, know where the pitfalls herein lies. 2 different points here that are creating a heavy resistance level that's only about $70 away on this stock. So there's very limited reward for Tesla shareholders getting in at this point in time if it's unable to break through this resistance. From a fundamental standpoint, one thing I would encourage you to remember is that Tesla, in order to justify its share price over $1,000 a share, has to sell 16 million cars. 2021, it sold 1 billion a car. And it just had a shutdown in Shanghai. So that's going to also hurt the company's ability to produce the number of cars that it can justify its stock price. And it's worth mentioning that Ford, GM, all the companies out there, the competition is building. All the companies out there have a plan in place. So while Tesla was the first to the electric vehicle industry, there's a ton of companies right on its heels that are going to start sneaking into its market that will start hampering some of its growth. That's just the nature of competition. The more competition you have, the more distributed those profits become. I want to also mention too on this chart, I want you to look at December of 2020, where it had a very strong rally that took the price from the 500s all the way up to $900 a share. And then it had a significant pullback, almost 50%. And then it bounced, came back down again, tested those previous lows, and then went on to have a massive rally. You fast forward to today, you have a massive rally of almost 50%. And then you have that bounce. And with rising interest rates and with a market that is fighting the Fed and with a lot of economic risks, the potential herein lies for us to see another pullback back down to these lows at 700. And there's a ton of support for it at the $700 level. And I know a lot of people aren't going to like, but the stock in and of itself is very much in a bubble right now. And my job as a trader is not so much to worry about how much money can I make off of a trade, but how to manage the losses. And managing the losses also comes down to avoiding situations where the risk far outweighs any of the reward that might be able to be reaped from a trade. So the takeaway on this stock, the stock is an incredible American story. I love Tesla. I own a Tesla. I think the car is awesome. But with increased competition and having to sell 16 million cars a year just to justify its current share price, I don't see that there's a lot of further price increase in the stock, let's say 1 to 2 months out. Instead, I see a scenario where the risk is rapidly increasing in an ever-growing stock market bubble, along with a limited amount of reward. So what's the best play here? I would let it come back down again. When a stock is running 45% in just 2 weeks, that is not the time to all of a sudden decide, I want to be long on this stock. Now, if you're already long, start looking at, okay, what if Ryan is right? Where do I want to start getting out at? And if Ryan's wrong, and I'm not trying to talk in a third person here, but if I'm wrong, then that's great. At least you managed the risk along the way in case I was right. So if you enjoyed this video, I'd encourage you to like the video and make sure to subscribe to get all my notifications going forward. I put out a few videos every week, and make sure to click the join button down below so that you can get all of my market research each and every day. Thank you guys, and God bless.